Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, math isn't my thing. Probably not surprising. I'm a word guy, right? And when I was in high school, I have to admit, it wasn't uncommon for me to end up with 5 A's and a D on a report card or a midterm report. That D being in whatever math class I happened to be taking. I took Algebra 1 twice. I took Algebra 2 twice. I barely escaped college calculus with a passing grade. So, yeah, math is not my thing. I put part of the blame on not ever having a great math teacher in like middle school or high school. I never really had somebody to teach me to do math the way my brain works. But, I mean, most of it was just me and my right brain dominance brain. But while I'm not great at math, I recognize it's important, and I respect its absolute nature. The answer to a math problem is right or wrong, and I really like that. I like that black and white, right? I mean, I'm sure that there are some mathematicians that could provide an example of a math problem with more than one answer, but generally, 2 plus 2 is 4, right? It's not really up for debate. And, math constrains reality in a way that words can't, right? I can massage language in all kinds of ways to convince you of this or that, right? A smooth talker can convince a lot of people of about anything. Meanwhile, math is sitting over in the corner saying, yeah, 2 plus 2 is still 4, no matter how you spin it. So in other words, math always wins. And with that in mind, I want to cover a couple of topics today where math is, quite frankly, running all over the spin. But first, I do want to thank you for taking time out of your busy day to listen to the show. And I think that this is actually episode 100 of the Midweek Memo. I have 99 scripts in my folder, and I remember specifically deleting one. So that would mean that this was 100, although it's possible I might have deleted 2. I guess I could do the math and figure out exactly what number this episode is. But as we've already established, I don't really like to do math, so we're not going to do that. But it is somewhere right around episode 100. So I really do appreciate all of you folks who listen in. And I want to ask you to do me a favor. If you like this show, take a minute, go to wherever you listen to your podcasts and leave us a good review. Give us that 5-star review and, share the episodes in your social media. It will help us to grow the show. We're not charging you anything. So if you could do that, I would be greatly appreciative. So people are still out there talking about the possibility of tariff rebate checks. In fact, there have been some rumors that these checks might actually go out before the end of the year, but that's nothing but a rumor, and I think it's pretty unlikely since Congress will ultimately have to approve any type of payout. And, whether that happens remains to be seen, although I do think if it gets introduced, you're going to have a lot of Congress critters who are going to have a hard time voting no to a handout that would almost certainly endear them to voters. And I mean that whether we can afford these rebates or not. And by we, I mean the government. And by afford, I mean pay for them without borrowing more money. So regardless, there seems to be some genuine momentum for this tariff rebate. And on top of that, as recently as last week, President Trump claimed that the government was going to start paying down the debt with this tariff windfall. And every once in a while, I'll still see people out there on social media saying, yeah, we could replace the IRS and get rid of the income tax with all of this tariff revenue. But the problem is Uncle Sam can't afford to give away tariff money, and there isn't enough tariff money to close the budget deficit, much less pay down the debt and give everybody $2,000. The pesky math just doesn't work. So tariff revenue set a monthly record in October. We got the October Treasury statement just a couple of weeks ago. And we had more tariff revenue than has ever been collected in 1 month. Okay. The total was $31.4 billion. That was the record customs receipts. It was a 330.1% increase in custom receipts compared to October 2025. So we are, from a percentage standpoint, collecting a lot more tariff money. But remember the number that I said, $31.4 billion. Now, that's a lot of money. So let's start printing up those stimmy checks, right? But wait, there's more. The federal government spent $689 billion last month. In other words, record tariff receipts paid for roughly 4.5% of the spending for 1 month. And even with that record level of tariff revenue, the federal government still managed to run the biggest October budget deficit ever. The Trump administration spent $284.35 billion more than it took in to kick off fiscal 2026. Keep in mind that for the federal government, the fiscal year begins October 1st, so we're already into 2026 as far as the federal budgeting year goes. So that $284.35 billion deficit was about 10% higher than last year's October deficit, and it was about $200 million more than the previous October record that was set back in 2020 during the pandemic lockdown era. Yes, the federal government just ran a budget deficit that was bigger than the one they ran when everybody was locked in their houses and the government was spending money hand over foot for stimulus. So this October deficit, the recent one, was inflated by the shifting of some November payments back into October. And you see this quite often on the Treasury statement. They'll have to move payments up a month or back a month, especially if the end of a month falls on a weekend or if you have holidays in there. So that's what happened. And if we factor out those calendar effects, the deficit would have been a mere $180 billion. And that would have actually been a 29% reduction from last year's October deficit. So that sounds good, but don't start celebrating yet because it would still rank in the top 4 highest October shortfalls on record, even if you do away with those calendar effects. Now, keep in mind that Uncle Sam ran this massive deficit while the government was closed. And I'm using air quotes around closed. A Treasury Department official told Reuters that it was unclear how much spending was reduced by the government shutdown, but estimated that it was less than 5% of the total outlays. But even so, the government was closed and we still ran a record budget deficit. And it's also important to note that salaries and other outstanding obligations that were not paid during the shutdown are now due as the government is fully operational again. And that means we actually could see some higher spending in November as some of those bills that were not paid in October are shifted forward. So it'll be interesting to see what the November deficit looks like, and we can kind of put the two together. But right now, it don't look good. So if we include the tariff money, the federal government took in $404 billion in October. That's another important number. Remember that the tariff revenue was, let me go back and look. I don't remember it right off the top of my head. Tariff revenue was $31.4 billion, and we have total revenue of $404 billion. So tariff revenue is just a drop in the bucket compared to all of the other taxes and fees that the government is collecting. And when we look at the October revenue number, it was a 24% revenue increase from October 2024. Now, I'll tell you what, I would love to have a 24% raise in my paycheck. It would really help me a lot. Didn't really help the government so much. Even with that, we still have this massive budget deficit. So here's the reality check. It should be clear that claims that the federal government is going to use the tariff money to pay a dividend to the poor and middle class taxpayers and pay down the national debt and get rid of the income tax. This is nothing but political rhetoric. Math is the great enemy of this ambitious plan. There isn't enough tariff revenue. Now, I have heard President Trump claim that tariff revenue is going to go up this year, even more, because a lot of companies have run down their inventories that were built up before these taxes were levied. And this is a plausible argument. I could see that. A lot of companies front-loaded their inventories to try to avoid the tariffs. Those inventories are starting to run down, so they're going to have to bring in new products, which means they're going to have to pay the tariffs. So that's a possibility. But is it plausible that tariff revenue is going to increase to $150 billion per month? That would be a 377.7% increase over the record that we just set in October. And that's what it would take just to close the average monthly deficit that we ran last year. We're not talking about paying down the debt. We're just talking about getting revenue up to the current spending level. And I have to ask this, aren't tariff rates going to drop as the Trump administration works out more trade deals? I mean, I was told that that's what these taxes are for, that they're really just a negotiating strategy and that we're using them to get more favorable trade deals, better terms from other countries. So once that happens, ostensibly, tariff revenue will drop, right? So we may see some increasing tariff revenue because inventories are running down, but we could see some lower tariff revenue if indeed we're getting better trade deals. So let's just be honest here. Anybody who believes that tariffs are the solution to our fiscal problems, they're living in a mathematical fantasy land. The numbers simply don't work. The only solution to the budget problem, to the national debt, to the budget deficits, is to cut spending. Because Uncle Sam does not have a revenue problem, it has a spending problem. The only solution is to cut spending. Now, as I've already mentioned, the Trump administration blew through $688.72 billion last month. That represents a 17.9% increase year on year in spending. Last year, despite all of the hype about DOGE and some lip service to cutting spending during the early days of the Trump administration, the U.S. government spent just over $7 trillion last year. $7 trillion with a T. That's an average of $583.3 billion per month, or get this, $19.2 billion per day. That's how much the federal government is spending. When you go to bed tonight, the federal government, on average, will have blown through another $19.2 billion. And despite some very non-specific talk about spending cuts, there seems to be little to no commitment to dealing with the runaway spending in any substantial way. These people in Congress can't even seem to get their heads together to extend the current spending, right? We had this big government shutdown. We're arguing over the budget. We had the big, beautiful bill, and it cut some spending, but it increased spending in other areas. Furthermore, those cuts, quote unquote, were from projected spending increases. In other words, if spending was supposed to go up $10 in this particular department, now it's only going to go up $5. They're calling that a $5 cut. Actual expenditures, real expenditures, still go up, just not as fast as originally planned. The bottom line is that even with the big, beautiful bill, spending will increase on an absolute basis. And it does over and over again. And all of that waste that was uncovered by DOGE, virtually none of it was actually removed from the budget. And this is par from the course, or par for the course, right? You might recall that President Biden promised that the pretend spending cuts would save hundreds of billions of dollars with the debt ceiling deal that we had when Biden was in office, also named the Fiscal Responsibility Act. I should say misnamed. That never happened. There was never any spending savings from that bill. And, it's just the way it goes. That's the way Congress does. They spend money. Right? Now, supporters of things like the big, beautiful bill, they say that the economic growth stimulated by tax cuts will ultimately boost revenue and narrow the deficit. However, history casts significant doubts on this claim because the amount of revenue generated by taxes and these things never measure up to the level that are projected. Here's the ugly truth. The government isn't committed to cutting spending in any meaningful way, and it always finds new reasons to spend even more, whether we're having a crisis at home or a crisis overseas or a war or whatever it is. There's always a new reason to spend money, and there's always an excuse not to make the cuts, at least not right now. Now, I've talked before on the show about the ramifications of this massive national debt, and we've talked about the fact that a lot of countries are starting to look over here at the United States with squinty eyes, thinking, if they can't get this spending thing under control, maybe we should stop buying their debt, right? Maybe this isn't a good bargain. Maybe we shouldn't keep, forking over money to this drunk sailor who is spending with reckless abandon. We've talked about the fact that the interest on the national debt right now is the second largest budget item, only behind Social Security. We're spending over $1 trillion every single year just to pay for the interest on that debt. And ultimately, who is paying for all of this? You and I are. We're paying for it in inflation. All of this is extremely inflationary. Borrowing and spending is ultimately inflationary because the central bank is forced to stick its big fat thumb in the bond market, right? It does things like quantitative easing. It cuts interest rates. And this is inflationary. So you may not be getting a higher tax bill. You may have gotten some tax cuts from the big, beautiful bill, but you're paying the inflation tax every time you go to the grocery store or the hardware store or buy some clothes or go on a trip. That's the relevance of this. This is part of the destruction of your money. And that's why we're talking about it, because as a person who cares about sound money, this is something that needs to be solved, and it's not being solved. It's just being kicked down the road and even exacerbated when you start talking about tariff rebates, when you're just going to have to borrow more money to do it. But the government can print money, and so that covers a great number of ills, at least in the government's eyes. But again, you're paying for it every time you go shopping. And, the sad fact of the matter is you and I, we can't print money. We're not allowed to do that. We'll go to jail for printing money. And, for everybody, budgets are tight right now. A lot of people are struggling to make ends meet. And, you're probably looking for some affordable gift ideas. Well, we've got your back at Money Metals. Now, when I was a kid, my grandma would stick cash in a card for me. I bet yours did too. It was great, right? Now, my grandmother increased the amount as I got older. I guess, she was adjusting for inflation and also, I guess, for my age. But I had a buddy, and his grandmother was still giving him a $10 bill when he was 20 years old. Now, as you can imagine, that cash didn't go nearly as far as he got older than it did when he was a little kid. And it wasn't just that he wanted to buy more expensive things. The purchasing power of that $10 was rapidly declining, right? Now, if you get $10 in a card, it's almost like getting a quarter or something, right? What do you buy with $10? So why not give your loved ones real money this year? Don't stick fiat paper in a card that's just going to devalue and buy less tomorrow than it would have today. Get gold and silver. We have a full page of Christmas gift ideas that you can check out. And it's over at moneymetals.com/Christmas-gold-silver. And I'll link to that in the show notes page. But again, it's moneymetals.com/Christmas-gold-silver. And I'll link to that, as I said. But there's a lot of great gift ideas, a lot of cool Christmas-themed silver and gold items. And then we also have a link at the top of our page for specials if you're looking for some good deals. So we got your back this Christmas, and you don't even have to go out and fight traffic at the mall. So we've talked about the tariffs and the budget and the math there. While we're on the subject of math, let's talk about the silver supply. So as you're probably aware, silver topped $58 an ounce on Monday, a new record. It did slide a little bit on Tuesday morning on some profit taking. But hey, it rebounded again. I just looked. We're over $59 an ounce for silver. I expected silver to really start running up once it topped $50. I don't know that I expected it to start challenging $60 that quickly. But, when you look at silver this year, it's gained over 99%. It's basically doubled in price this year. And a fundamental dynamic that is driving this rally in silver prices is the fact that there simply isn't enough metal. So we're talking about math again. Think of it as a math equation. If the world needs 10 ounces of silver, but only 9 ounces are being produced, that gives you a 1 ounce deficit, right? And you have to find that extra ounce somewhere in the above ground stocks. Now, back in October, we had a silver squeeze, and it helped propel the price of silver to that record at the time of $50 an ounce. And when this was going on, analysts explained it as a temporary displacement of metal. So I'm going to link to an article in the show notes page that kind of gives you the entire anatomy of this silver squeeze. I'm not going to go over the whole thing here because that's almost an entire podcast in and of itself. But a basic overview is this. Last spring, we had a significant amount of silver that moved into the United States due to tariff worries. People were worried that the U.S. was going to levy tariffs, so they went ahead and shipped silver into the United States to kind of get ahead of it. So this ended up leading to a shortage of metal in London. Now, keep in mind that in the silver market, there are several significant trading hubs. There's New York, there's London, and there's Shanghai, maybe Hong Kong to some degree. So these areas of these hubs of trade are where there are large bullion vaults that are full of silver, and silver flows between these hubs to kind of meet supply and demand in the various regions. And so, like I said, when people were worried about tariffs, they began moving metal to New York. And according to Bloomberg, the amount of free float silver, which is metal that's not already committed. So a lot of the metal in London vaults are committed to ETFs. It can't be used for anything else. It just has to sit there. It's backing up these ETFs or other funds. So what is left is called free float silver. And that's silver that can be sold or loaned out or used in various ways. It's available silver. And that available silver dropped from a high of the high of 850 million ounces to just around 200 million ounces very quickly. It was a 75% decline. Metals Focus estimates that the available metal dropped as low as 150 million ounces. So it's kind of a crisis in London. And then we had, at the same time, kind of this perfect storm where we had unprecedented silver demand in India. And that pushed the silver market over the edge. With gold at record highs, we had a lot of Indians that were turning to silver. And this put further pressure on London supplies. So that's what caused the silver squeeze. We had lease rates going way up. Everybody was scrambling to get metal. Money Metals actually shipped several pallets of 1,000 ounce silver bars to India. So there was this significant displacement of metal. And the market ultimately adjusted with a lot of metal flowing out of New York back into London and kind of easing the squeeze. And when that happened, we saw that price pressure kind of ease off. We had the correction, and here we are today back in a rally. So after the pause, silver has resumed its climb. And as an ANZ Group analyst put it, quote, shortages in the global market as a result of the recent squeeze in London are still being felt. So in other words, they moved metal around. They kind of eased the pressure in London, but now we're seeing issues in other areas, right? In fact, according to the Bloomberg article, the recent flow of silver into London has shifted the squeeze to other centers. In particular, warehouses associated with the Shanghai Futures Exchange report the lowest silver inventories in nearly a decade. Meanwhile, silver lease rates have climbed yet again, reflecting strong demand and a limited supply of available metal. So, what I'm driving at here is this isn't a problem that can simply be solved by moving metal from one warehouse to another. The issue is that demand has outstripped supply for several years. It's math, right? People need 10 ounces of silver. The world's produced 9. We have a shortage. And according to Metals Focus, silver is on track for its 5th straight structural market deficit. So after setting a record back in 2024, industrial demand is actually expected to drop by about 2% due to the high price pressure. And this will drive overall demand down by around 4%. And this is projections, of course. However, mine output is expected to continue to be flat, and there still won't be enough metal produced to cover the offtake. And even with the slight 2% decline in industrial demand, it's still going to be close to what we were calling record levels just a year or two ago. Metal Focus projects that demand will outstrip supply by 95 million ounces this year. So that would bring the cumulative 5-year market deficit to 820 million ounces. That's basically an entire year of average mine output. So in other words, over the last 5 years, demand has outstripped supply to the point where you would need an entire extra year of mining to make up that deficit. Since 2010, the silver market has accumulated a supply deficit of over 580 million ounces. So, even going back, we've been running this kind of deficit for quite some time. To make up the supply deficit, silver users will have to draw from existing above-ground stocks. That will likely require higher prices. So it's not like there's not enough silver. Like, there's a lot of silver sitting in private vaults. There's silver in the ETF funds. But what has to happen is the price has to get high enough for those people to release that metal into the market. So that's what you're seeing. It's basic supply and demand. It's basic math as well, right? Not enough metal, you got to get the metal from somewhere. And according to most analysts, even with the higher prices, it's not very likely that mine supply is going to quickly grow to erase that supply shortfall. It's interesting looking at the mining statistics. Silver mine output actually peaked in 2016 at 900 million ounces, and we haven't been that high since. Up until last year, silver production had actually dropped by an average of 1.4% every single year. So you were seeing declining mine output. In 2023, mines produced 814 million ounces of silver. So it appears that for at least the next few years, we're going to have to depend on drawdowns of those above ground silver stocks to meet the silver supply deficit. So that is very bullish for the price. And silver is also getting a boost from expectations that the Federal Reserve is going to continue easing monetary policy. Gold is getting the same boost. In fact, that's why I think we've seen a pretty healthy rally in both gold and silver this week. People are looking at the Fed. They're saying, yeah, I think the Fed's going to cut rates again in December. Now, after the last meeting in October, everybody was kind of doom and gloom because Jerome Powell did his open mouth operations and he tried to convince everybody, well, we may not cut in December. Now everybody thinks we're going to cut, right? So the U.S. Also recently added silver to its list of strategic minerals. And I'll link to an article in the show notes page about that as well. And this could add to demand pressure and supply shortfalls as well. Metals Focus Director of Gold and Silver, Matthew Pigott, told Kitco News, quote, "There's definitely going to be far more tightness in the silver market with this new designation." And according to Bloomberg, quote, "Fear of a sudden premium in America has made some traders hesitant about sending the metal out of the country, offering little prospect of relief should the global market tighten further." So you see these demands. It's all math, right? Not enough silver. There's not enough bars. And we can move bars from New York to Hong Kong, to Shanghai, to India, to where they're needed. But there still needs to be more bars of silver. That's the fundamental issue. These fundamental supply and demand dynamics should continue to support the silver price, at least for the near to midterm. It's one of the reasons I'm bullish on silver. So math, right? You got to do the math. If the math doesn't work, your plans probably aren't going to work because you can't spin your way out of math, right? I can write some fancy words and I can make things sound really good, but the math is the math. And the fact of the matter is, $34, $35, $36 billion a month in tariff revenue ain't paying for no rebates. It's not going to, cover the deficit. We're not going to pay down the debt with that. So all of the things that have been in place for the last couple of years remain in place when it comes to the gold and silver market. We have a central bank that is intent on cutting interest rates, easing monetary policy, raising inflation, further devaluing your dollar. We have a federal government that has a massive spending problem with nobody really willing to make the cuts necessary to actually fix the fiscal problems. So that means we're going to continue borrowing and spending. That means the Federal Reserve is going to continue to have to support the U.S. government with this loose, easy monetary problem, loose monetary policy, which again is inflationary, devaluing your money. That's the theme of the day. And that's the math that matters. The fact that every single day your dollar buys less and less. You know, I say this all the time, but these are not policies that you can vote away. You can't wish them away. It is what it is. What you have to do is prepare yourself and try to put yourself in the best position that you can to preserve your wealth and prosper despite what the government is doing to your money. And the way to do that is to save in real money, gold and silver. You don't want to save in fiat, right? You don't want that envelope with the $10 bill. You want an envelope with a silver eagle in it, right? Because that's going to retain its value. It's going to hold its value. They're not going to print away the value of gold and silver. And as I said, we have some fantastic gift ideas over at Money Metals for your loved ones. We've got some good deals going on right now. You can check out the specials. But today is the day you should take a moment and give the folks over at Money Metals a call at 800-800-1865. Talk to a precious metals specialist. These folks are great. They'll answer your questions. They can help you figure out how gold and silver can fit into your investment strategy, how you can, invest in an affordable way. They're a wealth of knowledge, and they're happy to answer your questions, so take advantage of that. Now, I know a lot of folks don't like to talk on the phone, so instead you can go to moneymetals.com and you can chat online with a precious metals specialist. Or, if you're thinking, I just want to get a cool gift for my wife, or I want to get some, a cool gold or silver gift for my kids, then head over to moneymetals.com. Just click on the right links. Find what you want, buy it, we'll ship it right to you. Or if you want to buy some, investment gold and silver, we can store it in our state-of-the-art bullion facility in Eagle, Idaho. Amazingly secure. But do it today. Don't keep putting it off, because you know what? Your dollar's going to be worth less when you get up tomorrow than it is right now. That's just the way of the world. That's what the government is doing to your money. So with that, we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get a lot more information on everything that I've talked about today on the show over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. We send out those articles from time to time, keep you up to date on what's going on. And of course, you can subscribe to the Midweek Memo podcast on your favorite podcasting platform. And when you do, you'll also have the opportunity to tune into our Market Wrap podcast that airs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. This week, I'm going to be talking to Peter Kraut, who is an expert in silver, so you want to check that out. But do all of that. Again, I thank you so much for listening to what I think is episode 100. I hope you have a fantastic rest of your week, and I will be back again next Wednesday.